Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks for everybody for watching and listening.
Great to be here as well. So today is March 15th, and the reason I'm giving that context is we'll be talking about Silicon Valley Bank. The FDIC, or Federal Reserve, closed Silicon Valley Bank on March 10th. Got a few questions from clients. And as I have answered those questions to my clients and Trishul has answered those questions to his clients, we wanted to kind of compare our answers, kind of see what our thought processes were, what we were telling clients, and be able to use this time for a longer, more nuanced, kind of complex conversation to understand what's going on, what happened, acknowledging that we are not experts in the banking sector. We are try to stay informed. We try to stay up to date. I have worked for a bank decades in the past at this point. So I'll try to relate a little bit of what I learned there, although it doesn't really affect any of my clients or their conversations. But trying to provide kind of some context for me in general, like why I'm not worried. So before I get into how do banks work, Trishul, when clients first reach out to you and asked about Silicon Valley Bank, what was your initial feeling? I'm curious, like, was this something or was this also just more noise?
Well, the big concern is, deposits, right? Can I get my money out? And that's what clients are likely concerned about, just initially in terms of a knee-jerk reaction, unless you're centrally involved in the actual situation. That's probably the main thing that you're thinking about. And
one, like, do you have money at Silicon Valley Bank?
Yeah.
And if the answer is yes, like, okay, now there's something to actually worry about. But if your clients don't have money at that specific bank, they're thinking, oh, I have money at this other bank. Will I be able to get my money out of my bank?
Right. And there's always this concern, and we've heard this phrase before, it's called contagion. And the idea is you have a little forest fire that starts, in the northwest corner of the forest, and the wind blows and it just starts spreading. Bank runs in particular, used to be just a common occurrence in the banking system in general, before we had all of these checks and balances in place. And the idea there is, Aaron, I'm sure you're going to get into this, but banks don't keep all of their money on hand so that if everybody shows up, they can't really physically give all that money out. Wasn't that kind of the plot line to It's a Wonderful Life?
I use that exact example with my wife. It's like, that was the plot line of It's a Wonderful Life. It was a classic bank run. But I think that movie took place before a lot of modern regulations were in place. But yes, I used the bank run from It's a Wonderful Life as an exact example of what a bank run is.
Right. Yeah. So the notion is the bank takes in deposits and they loan out money, and they don't actually keep a sufficient amount of capital on hand within the bank itself, because most of it is loaned out. In fact, a far greater percentage is loaned out, which, Aaron, I'm sure you'll get into. But if everybody shows up and says, I want my money back, then there could be some trouble because that money just physically isn't at that bank.
Yeah. And so that was one of the first things I was trying to explain to a client was just the idea of the reserve requirement. So both conversations with my wife, my father-in-law, a couple clients, if a bank has $1 million in customer deposits, total number of people put $1 million in or $10 million, they can loan out via auto loans or mortgages most commonly. usually on the scale like $900,000 or 9 million of the 10 million, so 90% of it. So they only have on hand on the scale of 10%. There's actually a relevant number I'll get to in a minute. And that's how banks make money, is the interest rate that they charge on those loans, auto loans, mortgage rates, and it's kind of depending on the risk that the particular borrower has and credit history and other factors, they might have a higher or lower interest rate. And they pay out interest rates on savings accounts, CDs, and the bank just makes money on that spread. All they're trying to do is make money on that spread. And going back pre-1920s, I think, there were no kind of federal requirements in place. It was just banks tried to make money, and the banks took on all that risk. So if 15% of the kind of client deposits came in and said, I'd like to withdraw all the money from my account, and the bank only had 10% of the money on hand, that's a bank run, and the bank closed. So in the 19 teens or 20s, not quite sure, the Federal Reserve stepped in and became the lender of last resort and said, okay, we'll back up all these banks and make it ways for some banks to lend money to other banks. And that's where the Fed funds reserve, or sorry, Fed funds rate comes from. That if one bank needs to make sure that they have 10% on hand and they only have 9, they can borrow from another bank. And they have to pay the Fed funds rate as interest, as the overnight interest, to that other bank to make sure that they meet those reserve requirements. I think originally the reserve requirements were around 25%. So if you had $1 million in customer deposits, you could lend out $750,000. The went down to about 12% for a long time. Then it went down to 10%. And actually, I don't know how relevant to our conversation will be, but in 2020, that went down to 0%. So there's actually currently no reserve requirement, regulatory requirement on banks. And the reason the Federal Reserve will do this is this gets into monetary policy, actually. You hear about the interest rates that they can charge. They can lower the interest rate, making it easier for people to borrow money. And the more kind of money borrowed, the more money circulating, you get into like kind of economic or systemic wide liquidity. And I think it was early March of 2020. So this is kind of really early in COVID. They want to make sure that nothing was shut down. So they try to make it really easy to get money or get access to borrowing. So interest rates went down to 0. It's kind of hard to make interest rates go below 0. There technically are ways to do that, but realistically, you want to leave interest rates at 0. And the next way to make it easier for more money to get into the system is lowering that reserve requirement. So in 2020, the interest rates were at 0 and they lowered the reserve requirement down to 0. So there are pros and cons to that of why that was the case. And I don't actually know what the reserves were for Silicon Valley Bank. I don't know if I've seen that kind of record, but I have read about what they kept those reserves in. But that's a quick introduction. Bank takes money in, they lend out as much as they're allowed to, because the more they lend out, the more interest rate they make, and they make money that spread between what is lent out and what they're paying on deposits. So I think that's a good introduction on kind of bank runs and how that impacts deposits and kind of that reserve requirement. But for Silicon Valley Bank, which is kind of why the general question of contagion comes into place. If Silicon Valley Bank and a few other small regional banks, there was a bank run there, why won't there be a bank run at my bank? So kind of, what did you respond to that?
So I guess this is where the whole notion of FDIC insurance comes into play. And the idea behind that is one of the checks and balances that the government has put in place, so the Fed has put in place, is this notion that up to a certain limit, you probably heard this number many times over the last couple of weeks, actually it's only been a week, but it seems like in internet speak, it's been like a year. But anyway, so the limit is 250,000. There's some nuances in that, which I'll get to in a bit. But the notion is if you're below this limit, any losses that you might suffer because of a bank going under are covered by this insurance program that's set up by the federal government, or that's the rules were put in place by the federal government. And the idea there is, yeah, if you're below that, you shouldn't worry too much about your deposits, getting stuck or getting lost, that is, from the bank, because it'll be taken care of. And one thing that the government has learned over previous collapses is that has to happen quickly, and that is kind of what happened here with Silicon Valley Bank. The government did step in. Now, the big concern when this first initially unraveled was that the vast majority of accounts within Silicon Valley Bank were well above that cutoff for FDIC insurance. Meaning, I think the numbers I heard were like over 95% of the either accounts or the number of assets that were held at that bank were not covered by FDIC insurance. And that's a bit scary, because that means those individuals or businesses, frankly, which we know that had their money with Silicon Valley Bank, most of it wasn't insured. So that is a bit of a scary situation.
So the idea is that if I have $50,000 in cash, $100,000 in cash, I don't need to worry about losing my money. So I don't need to withdraw it. And if enough people have kind of below that number, then just the presence of FDIC insurance in the first place might be enough to mitigate or prevent a normal bank run. It's very herd mentality. A lot of psychology involved actually in it. It's almost like a prisoner's dilemma. As long as everyone leaves their money there, everyone's fine. But as soon as one person takes their money out, everyone needs to race and take their money out before the money's gone.
Yeah, like in this situation, let's say that reserve requirement is 10% of the bank's assets. Well, if only 5% of the people are doing their normal business activity of money in, money out, everybody's fine. But if it passes that tipping point of more than the bank has on hand, then things could get scary, especially if this FDIC insurance is not in place. And you think, okay, well, I don't want to be, last in line. I literally will run to the bank. That is what a bank run is. People will run and get in line first so that they can pull their money out before everybody else.
So I think the two general topics that I've been thinking about are, one, why would you keep that much cash in a single bank? And two, what happened with SVB specifically? I guess that doesn't have to be in chronological order. Like, which of those kind of first, the way I ask it, what's your initial thought?
Okay, so let me share some thoughts on just FDIC a little bit, so that'll help clear some of the questions on why would you keep X amount at a given bank. So let's see here. So, okay, just the black and white of what FDIC is. I'm going to even share the screen. I'll share my Cliff Notes today. This is from ChatGPT, because it's great at summarizing little snippets of information that we need to talk about. So let me just put that up there. Can we both be up there? Let's see.
Okay.
Now is that visible? I don't know.
Yes.
Okay.
Now we are visible and the text is visible.
Okay, so here we go. FDIC insurance is a type of government-backed insurance that protects depositors against losses. The key thing I want to focus on is FDIC insurance covers up to $250,000 per depositor, per insured bank, per each account. Now, what that means?
I guess for each account ownership category.
That's the specifics. And what an ownership category means is, for example, a checking account, a savings account, a CD account, And even a joint account would each count as a separate ownership category, meaning they each get a $250,000 tagged to it. Just very quickly, here's a quick Excel of how that might look for a family. Let's see if
I remember this is one of the things that did come up when I worked at the bank a little bit, of if you have a couple, husband puts in an individual account, husband puts in you can also, it's common with trust. Trusts also work as a separate entity. So husband's individual account, wife's individual account, and their trust account. Just those three kind of normal things, you're already at
right.
750. But yeah, like you could do the husband, joint, wife, like exactly. You have that good example.
Let's have it in the trust.
So it'd be one trust. It's per trust kind of thing. But yeah, same idea.
Yeah, let's assume each has their own trust for whatever reason.
Yeah.
Okay, so $2 million pretty easily. That's what we kind of see, right? Now,
go ahead.
So yeah, the notion is it's really not 250. You can have much more of that at a single bank, and literally you can go across the street to the next bank and do the same exact thing. So if you happen to have $4 million that you don't want to do anything else with, you could have it secured under FDIC insurance across like 2 banks.
I think that's probably one of the key is it's a lot easy. It's really easy to go over 250. That's very, like as we just showed, it's easy to go over 250. And two, most individuals, the vast majority, aren't keeping that much in cash anyways. I don't have, the only clients I can think of that have ever held that much in cash for less than a year is that they're either buying a house soon or they sold some stock and they're paying taxes. And it's for their tax bill. And in both those cases, we didn't leave the money in cash for more than 6 to 9 months, sometimes even shorter than that. So I guess we could have tried to spread it out, but I think in both cases we were using a money market anyways, which doesn't have FDIC insurance. I want to kind of get to that a little later, but for most of my clients, with the presence of FDIC insurance and what they use cash for, I'm not worried at all. It's like the money at your bank, the odds that you lose money at any point because of anything like this are so low, it's not worth worrying about. And I think we've even seen with Silicon Valley Bank, one, you have FDIC insurance. Two, this doesn't mean that if you have money at Silicon Valley Bank that you lost everything. Most likely, so FDIC insurance, everything's covered easily. Even after that, the Federal Reserve steps in. They're trying to facilitate the sale of Silicon Valley Bank to another bank. And so another larger stable bank will buy out all of the customer accounts of Silicon Valley Bank. So most likely all those accounts will get transferred to that new bank, no problem, because you start to get into kind of capitalization structure of banks. So when this bank fails, all of the stockholders, they get nothing. They took on the equity risk. They're getting the upside of these aggressive transactions, and they lost their money. But that's the risk that comes to stocks. That's a normal stock risk. That's why you diversify across lots of stocks. Even bondholders, if Silicon Valley had a outstanding bond, I don't think they did, but bondholders would be kind of next lowest in line. The depositors and other creditors like that, they're highest on that list. So as long as there's something at the bank that has some asset that's worth something, the Federal Reserve facilitating the sale to the other bank will kind of use those assets to make sure that all of the customers are made whole before anyone else gets paid out. So even if you had more money than FDIC insurance can cover, because the banking relationship and the ability for banks to make money on your deposits, there is value there. So other banks will come in and kind of buy those customer accounts. So most of the time, even those over FDIC insurance don't have to worry about it. Maybe if you have a large amount, again, millions of dollars, you might have to wait a while before you get to it, or you might get 97% of it. That's like a realistic worst case scenario of how it's played out over the last 20, 30 years ish. And in this particular case, the Federal Reserve has already announced that they will guarantee all deposits at Silicon Valley Bank. This is one kind of a practical purpose of like, even though it's not FDIC insured, they don't mind stepping in to make sure that this happens. But it also is specifically trying to prevent that contagion. If Federal Reserve's kind of going to step in, then no other regional banks need to have their own bank runs. That they're trying to continue the analogy, like they're building that firewall or that line. They're cutting down the trees to the fire break to make sure that it stops at some point. And so this is their form of that. So for most of my clients, I'm never that worried. We're usually going to money markets for large cash deposits because we're trying to get a better interest rate, and the risk is so low it's acceptable. But from a practical perspective, I don't think any depositor is actually going to lose money in the Silicon Valley Bank situation. So what do you have any kind of thing to add on, like, just above FDIC insurance, the realistic risks for customers of any particular bank?
Right. Yeah. So, to put it into context for my clients, there have been situations where a client does come on board and they, for whatever reason, have, more than that amount. Well, we work towards figuring out a way to get under the 250, per named account type.
Mm-hmm.
And it's something that it is possible to do with not so much effort these days as well. For example, one thing that I do pitch to my clients anyway, it's a service. I may have even mentioned it on some of these podcast episodes, but I'll just flash it again.
Mm-hmm.
It's called Max My Interest. And initially, or previous to the last month, the big benefit here is that it opens up different accounts in your name and automatically moves excess cash to whichever bank is offering a higher interest rate. Currently the prevailing rate at the list of banks that this service connects to is like 5%. And the idea there is, let's say you are saving up for that house and you need to keep a couple $100,000 in cash, but you don't want to keep shopping around every few months to figure out where the highest rate is or something like that. Well, then you could set up this service so that you keep $50,000 in your current checking account, and everything above that gets automatically swept every month into this service, which will automatically move it to whichever bank is giving the highest rate at that time. So you don't have to kind of think about it. Yep. And the second thing that it does is it keeps those balances below 250. So if you do happen to have $500,000-$600,000, it would distribute that 250 across multiple accounts with you having to worry about that cutoff. And I say that because I also had, like another client who had a home closing and they were going to pay in cash. Again, a lot of money to keep around, but we were able to, just use this type of service to handle that type of situation. Now, if we were in the middle of a Silicon Valley Bank situation for that particular client and things got messed up, having all that money in his checking account may have been a bit of an issue. But again, I wasn't concerned because we had already taken these proactive steps to, move things around and keep the balances where they should be. So that's kind of, a thing one in terms of how to help mitigate this type of concern. And, frankly, having a service like that anyway, where you can set it up and not have to worry about, am I getting a good enough rate on my cash or my emergency fund? It's something that might be helpful. And then the second thing is just that notion of, okay, Silicon Valley Bank in general. Now,
before we get there, I want to extend a couple of more things. So One is just the financial advisor's recommendation of how much cash to keep on hand.
Mhm.
So because I follow a lot of sports news, Giannis of the Milwaukee Bucks, that's his first name. His last name, I'm gonna get it wrong. It's like Antetokounmpo. And I'm not even gonna try a second time. But his nickname is the Greek Freak because people didn't want to try and pronounce his last name either. But there came out news that he has money at 50 different banks to stay under FDIC insurance. And my first thought was, okay, so 50 times 250. Okay, it's just says it's his individual account. Okay, that's 12.5 million. Quick Google search says his net worth is 110 million. Is 10% of your net worth in cash appropriate? It's like, oh, maybe. Like I'm not gonna be. That's a little bit like orange flag for me. I'm not gonna worry about that. But that's huh. That's interesting. Okay, but I'll move on because most of my clients, we keep enough in cash for a year's worth of expenses. So some round number that helps them sleep at night, 50K, 100K, 150,000, something like that. That I have this, and then we invest the rest in a diversified portfolio of stocks and bonds. And if we want to be more conservative, we go more on the bond side. We go safer. We go shorter term bonds. We use more treasury. There's other ways to be invested more appropriately for longer time frames than just leaving money in cash. So 10% in cash felt unusual, but at 110 million net worth, 12.5 million cash, okay. My next thought was, how does he keep track of 50 different banks? And you know what? No, he's a professional athlete. He probably has some advisor that's keeping track of this for him. And that's where the red flag came in. The possibility of fraud of the person you're trusting to track all of these different accounts that you kind of can't keep track of yourself. That I didn't like. That did not sit well with me. And spreading your money out in a way that you don't have to manage it yourself, but you need to be able to kind of mentally keep track. I have money here, here, and here, and you check statements periodically, as you get them. It's like, oh, yep, my money's still here, here, and here, things like that. And once you get to 50, there's no way that you can kind of know if something's missing from one of those accounts. And that is the other kind of comments I was thinking about of how much do you keep in cash from a practical perspective? And again, the tax bill and the down payment on the house are probably the two common exceptions, or home purchase, that we won't have to keep cash for this time frame because it's a large purchase. But even then, why the 50 different banks instead of one or even a few money markets? So before we get to Silicon Valley Bank specifically, I want to get your thoughts on kind of FDIC insurance versus a money market.
Okay, so a few things. It does come down to how much liquidity that you need in the short term, and that can differ, based on the individual. For your typical household, though, the short-term liquidity is just your monthly expenses, essentially, unless you know you have a big purchase coming up and you plan for that. And emergency funds beyond that tend to be, just 3 to 6 months of monthly expenses. So it shouldn't be too much. And that doesn't need to scale as your net worth goes up, meaning, your overall monthly expenses won't be in lockstep with your net worth as you add zeros to the end. So yeah, I don't know why
he's not spending $10 million a year.
Right. Unless, for example, a big reason why Silicon Valley Bank had so many accounts that were over the threshold is because these were small business ventures. These were venture capital businesses. And they needed that short-term liquidity to, frankly, most of it was probably to pay payroll, right?
Yeah, that's the exact note I had.
Yep. Yeah.
It's...
And
it's a prudent business strategy to keep 3 months, 6 months of payroll in cash, so that if there's a revenue dip or if some project doesn't pay off, that you can still pay all your employees until revenue comes back up. Like that's again a prudent strategy for a business, which is again one entity, to keep a few $1 million in cash to be able to make sure that they can make those employee payment obligations, payroll, if something happens to business revenue. Like that's a very normal thing.
Yeah,
So
so maybe that's why he had 50. I don't know what his business is.
maybe, I guess, like there's some very business savvy professional athletes who are trying to take advantage of their playing career earnings to turn their net worth into a few multiples of that. So
Yeah.
I guess maybe.
See, the other comment I would make is these are bank accounts, and he should be the one who has the access to move money in and out, unless he hands over custody privileges to somebody else. Meaning, for example, I don't have custody over any client's bank accounts, meaning I can't move money anywhere except for their account to their account, meaning their account at their bank to their account at their brokerage, and back and forth, right? If he has 50 accounts and he's handed over custody to somebody else, which again, I stay away from that because it does open up the doors for, like you said, fraud. You don't want to be handing over custody to just anybody, and you can't take that lightly. Like, that's a big privilege to have somebody else be able to move money at their whim. You know, that's a large part of, you know, what was behind, I'd say the majority, maybe even the vast majority of fraud cases that are out there.
Yeah, probably. And it's usually someone who's either earned trust, sometimes even a family member or an uncle who might be the slightly more money savvy one who's taking care of earnings of a entertainer athlete. Those tend to be the categories of higher wealth versus younger age. And you hear stories in the news of parents taking advantage of child actor earnings, something like that. But yeah, it does. Those do tend to be cases of fraud where technically it's the individual has signed off permission, whether it's via power of attorney or custody, for someone else to make their money decisions for them, and that opens that door.
Right. Yeah. So there's a difference between a limited power of attorney who can do certain things under certain situations versus giving somebody, you know, the keys to the bank vault and saying, you know, don't be evil or something.
Okay. So, but going back to my initial question, like, how do you feel about FDIC and banks versus the money market, and or what do you recommend to clients?
Okay, so then the other type of account where you could keep money is under like a brokerage account, where you can technically invest in money markets or treasuries or even securities like stocks and bonds, right? And this has its own set of rules that are governed around the whole brokerage system rather than the banking system. So, for example, we've been talking about banks, which are mainly meant to store money for checkings and savings and trusts. And the idea there is you want very short-term liquidity, whereas a brokerage account is more meant for investing, meaning for less liquidity for term purposes. There's a good amount of overlap, but the regulatory bodies that oversee both of these different types of services and products are different. For example, FDIC applies to the banking accounts, and then there's a different kind of insurance that applies to the brokerage account. That's SIPC, SIPC. And the notion there is you're not really looking to protect against losses with a brokerage account, because frankly, brokerage accounts go up and down, with the market or with bonds or with the movement of things. So you can't really insure against losses there. It's going to lose money often, and with repetition.
That's a normal thing.
Yeah, that's the point. So there is no coverage for losses in a brokerage account under SIPCA, but the notion there is it's actually meant to protect against fraud, meaning purposeful acts of deceit. I'm going to put a caveat there because it turns out Ponzi schemes aren't covered under that notion of fraud with SIPCA. So, for example, Bernie Madoff, all their clients were not made whole from the insurance provided by SIPCA, although they did help officiate the winding down of Madoff's accounts and the distribution of the money to make sure it's fair and equitable. Just kind of incidentally, the number I heard on that is like, for every dollar that was given to Bernie, people got about 88 cents back. So it wasn't horrible per se, considering that fraud took place around the 2000 period, where many people probably lost well more than that, just from market fluctuations. But they weren't made whole by SIPCA because of what I think is a clear fraud, but apparently a loophole in SIPCA, parlance. But either way, the notion is it's a different kind of account. It's a brokerage account. It's meant to protect against fraud, not losses. However, the coverage is, I think they're $500,000 per named account category type thing. So it's higher. But again, you're talking about fraud here, not losses. So you're not covered for an issue where there's no fraud, but losses occur. Now, the reason I bring this up is, for example, let's say one of those institutions goes under. Well, what happens then? And it's actually a little different, because let's say you do have a brokerage account. Well, the idea there is these accounts have their own separately managed, isolated funds, meaning it's not commingled. So those securities that you have in your account, those are tied to you specifically. They're not lent out to other people, meaning if you have IBM stock, it's your stock in theory. It's not used as collateral for the bank so that they can make more money in theory.
So I wasn't expecting to have credits. We do need such a margin in just a second, but it helps reinforce that idea, like with the money market, there's not like that reserve requirement, because it's just your money that actually you're kind of one of those tiny lenders. You're participating in banknotes that are like overnight lending, of when the banks have that reserve requirement and they have to lend money, like that might be where the money market invests, is that like overnight. So that's why you can get the better interest rate, because you're technically taking on the risk that the bank doesn't pay back the next day. But they're so short term and so high quality. In general, I find that these are perfectly acceptable. There was one time in 2008 where the money market broke the buck, where they didn't have enough money to cover it. So I remember seeing a few accounts, like the money market, which was always like a $1 par. So it was always a $1 account, like security value that just paid interest, went down to 97 cents. And they froze redemptions on that money market. You couldn't take money out. And I think 2 weeks later, 3 weeks later, like it went back up to $1, and no one lost money, but they did lose the ability to take money out. So I think that's probably the risk that I feel comfortable with, I guess I'd say, because this isn't that we need the money to pay bills this month. That's why we keep the money in the checking account. This is we need the money 6 months from now to buy the house, or next spring to pay our taxes. Like the risk of it not being able to access it for 3 weeks in the one time ever that I know about, but maybe only going back 20 years-ish, 30 years. Like if this happens once every other decade that you don't actually lose money, you just can't access it for 3 weeks. I think that's an acceptable risk for the higher interest rates.
Yeah, it's well, okay. So it's the notion of what does risk-free really mean? Like,
Yeah, exactly. Yeah, that is. I think you're right. It's we're going from a spectrum of stocks on one end, where if you held a Silicon Valley Bank stock, you're screwed. If you're a Silicon Valley Bank depositor, you're fine. And like as you like, we go from stocks to large cap stocks to bonds, like junk bonds, high interest rate, long term, and then like safer but long term, which have less risk of default but higher volatility. Then we go shorter term, and now we're getting like we're zooming in here to like short term AAA rated corporate bonds to like treasuries, or like I guess treasury might be like here, but like the money market might be like right in here somewhere. And then we're getting to like CDs over here to checking account, the next pay. So it's like all of this conversation, I'm trying to zoom in my mind, like is taking place on like right in this area of what is risk free.
right. And at some point, you just start splitting hairs, for some of these things where you're trying to measure things based upon 1 in 20-year events, right? And things like that. So at some point, you got to kind of just understand that nothing is 100% risk-free, right? An asteroid could hit tomorrow that nobody knows about, and I'm sorry, you're not going to get that money for a little bit.
Not even that you lose money, it just takes us a week or two to, clean up the asteroid.
Right, it hit the building. I'm sorry. The cable went out. So at some point, you have to understand there's some amount of risk that we just have to swallow. And there's some relative risk to think about, but you have to also think about what are your goals. If you really do need short-term liquidity, well, here are the rough solutions. And they're very close in terms of safety, but let's focus on the goals. And then let's match it to what we can do. And then anything higher, like for example, a lot of people who I mentioned, the client or two that had the excess amount of the 250K, either spread it out or keep a 250K or less in the short-term bank and put the rest in treasuries, right? Something like that. Again, that treasury is in your name in a separate account at a brokerage. And what you're banking on there, not risk-free, because the brokerage can get hit by an asteroid or something, or they could have some sort of massive fraud going on, that may, get you dinged. But relatively, it's supposed to be safer because the actual instrument you're investing in is, in this example, a U.S. Treasury, which again isn't fully risk-free, but it's one of the safest bond investments on the planet.
Yeah. I think that's a good point. So we don't want to touch on margin real quick, but that's the example of if you wanted to borrow to be able to buy stocks at like you're borrowing half the cost to buy stocks. It allows you to add leverage to your account. If you have stocks in a margin account, the brokerage company can also use those shares to lend out to others. So that's the one kind of caveat to you don't hold the securities in your name. So if you have a margin account, then yes, that risk of loss is greater. It's also why most people don't use margin accounts, and the regulatory requirements of establishing one are much higher. You have to show that you kind of truly understand the risk you're taking on. But for most individual accounts, that's why I use SEI. They're technically SEI Private Trust Company, where they have accounts in client names, but SEI never owns the securities. It's always in the client's name. So if SEI went down, we could just transfer all of those securities to another brokerage, another custodian, because those aren't margin accounts. So yes, that bank run idea can't apply to brokerage accounts because there's no reserve or lending out of your securities, except for the margin account.
Yeah, like for example, a big reason why Madoff was had so many holes in it, or one of the big holes, is they didn't have separately managed accounts. In fact, they just didn't exist. All the money just went into one big account,
one big commingled pool. Yeah,
right. Yeah. So when you're dealing with a brokerage account, you want separate accounts, right? For that reason. And that's why you, instead of pooling your money, with, like, for example, a mutual fund, an ETF could be better from that perspective, because again, these are separate securities rather than something that's tied to a pooled vehicle.
Yeah. So again, we're like splitting hairs of like the risk of a mutual fund versus an ETF. I had not considered that, but yeah, I guess technically an ETF is safer from a fraud perspective than mutual fund, even though that risk is so minuscule compared to the normal investment market risk that applies to both equally.
Yeah. Well, also, coming from the hedge fund space, we had two options. You can go into a pooled vehicle, meaning a big account, or you can have a separately managed account. And some high net worth, ultra net worth investors, they just like that feeling of having a separate account in their name rather than a sliver in a pooled commingled account for the hedge fund.
Yeah. Okay. So I like that really good explanation, like kind of summary. Like, we're talking like these are all kind of as safe as realistically possible. And if you're going to have your money trying to earn interest, you have to take on some risk technically somewhere. And so kind of like managing that risk. And if you decide to take dollar bills out or gold coins and put them in your safe, it's actually like an inflation risk where now like just you're not earning any interest on that. So as soon as you're putting money to work somehow, there's no way to make it truly risk-free and get that interest rate. But all of these risks are kind of so minuscule, it's not worth parsing.
Yeah, risk gets tricky when you're on that tail, because it's hard. Just humans aren't designed to factor in those types of competing concerns effectively. It's hard to do, especially if you're not rigorously analyzing it and trying to make sense of it. The way I kind of think about it, for example, is sometimes you come across a risk in your daily life and you think, oh boy, that sounds bad. 10,000 people die a year of X. And what I try to do when I hear something like this is kind of normalize it in the context of something else that's risky. For example, if I find something where, 10,000 people a year die of X, but then I know, okay, 100,000 people die a year of, probably drinking and alcohol, something like that. Well, okay, I could be drinking and alcohol, drinking and, having alcohol. That's 10 times hurtful than this specific thing. Am I really going to go out of my way to avoid this one thing? Or, is taking some precaution, as I would with alcohol, even 1/10 the precaution, not 10 times more, right? Would that be sensible?
So
a part of
the example that I have in discussion with my wife of, I am more afraid of swimming pools than my daughter walking home from school by herself.
Right. Yeah.
And like it feels weird and scary as a parent to kind of phrase that, but that's where the risk lies when it comes to some of those numbers. Like those are, like I said, it helps provide kind of context for those types of rare events.
That's a great one. Like, for example, I read something. I'm going to mess up the numbers, so I'll put it in the show notes, but I'll get the order correct, hopefully, or the general ballpark. But something like 100,000 kids a year end up being abducted, right, in quotes. But of that, only 100 to 200 are from non-relatives or family members that didn't know the kid. Meaning, just to your point, the walking home from school chance is very low.
Yeah.
Over 100 times more likely it'll happen with somebody you know.
Yeah. It'll be family issues going on there that usually kind of custody settlements, something else going on between divorced parents, something like that.
Yeah, and so you back all those out and you talk about the actual walking home scenario. Well, that's far, far more safer than being around a pool.
Yeah. So, okay. So let's try and finish up with what happened to Silicon Valley Bank specifically. I've read a few things. I'll try and add in, but what was from what you've read, what happened to Silicon Valley Bank? And I feel like there were a couple other regional banks, but I think those were more cryptocurrency related. I don't want to address those because I don't think they really matter. But what happened to SVB?
Okay, so to put in a bit of context, I'll flash some talking points or slides here. Okay, is this big enough, Aaron? I don't know.
Yes. Yep.
Okay.
I can see Washington Mutual, Silicon Valley, Signature.
Okay.
I recognize those three names as bank failures.
Yeah, these are all the bank failures for the past X amount of years, maybe 20, 30, something like that. And prior to this, the biggest bank failure was Washington Mutual in 2008, which had about 300 billion in assets. And Silicon Valley came on the scene being the second largest in, I've heard history, and maybe near recent history, near being like 20, 30 years, something like that. That was 200 billion. So I think that was the big concern, that this is a big one. And it's the most notable one since 2008. And then very soon after that, Signature went under with about 100 billion in assets. So not good. And what happened over the weekend is essentially the Fed stepped in, and basically this was the weekend of like the 10th ish.
Yeah.
So on Sunday, the 12th, Aaron, this is the message I'd sent to you. The U.S. government guarantees all Silicon Valley deposits money available on Monday was the headline that I'd read. So the concern going into the weekend was that, as we had mentioned at the beginning of this conversation, over 95% of the deposits at this particular bank were not covered under insurance, which everybody was freaking out about, like the entire banking system / internet / news, etc. And yeah, it's a concern. That it was a concern because Silicon Valley Bank happens to have a lot of small businesses that are tied to venture capital funding, that are tied to technology companies that are trying to get off the ground, that employ tons of people. And yeah, this could be a huge issue if those employers cannot make payroll. And that's likely why the Fed stepped in and said, okay, we know it's 250K, but we're going to cover everyone.
Yeah, so I remember the Washington Mutual. I had to pull up a couple of things, but in that particular case, I was sold to JP Morgan Chase, and all the depositors just had their accounts transferred to Chase. No customer of Washington Mutual actually lost any money.
Right.
So,
and yeah, in this situation, if we kind of just look at the balance sheet of Silicon Valley as of the end of last year, so quickly, the balance sheet has the assets on the left and the liabilities and equity on the right. So assets are all the money that are basically tangible, and the liabilities are basically the money that has to give it back at some point. And the equity is basically the stock value, essentially. So stock value of about 16 billion. And at this point, the assets and the liabilities, assets around 212 billion, liabilities about 195. The concern is customer deposits were going down quickly. That's this big number here of 173 billion.
Yep.
And what that means is that the bank needs to sell some of its assets and use some of its cash to let that money go out the door. However, there were a bunch of securities that the bank had that were underwater. Now, they weren't marked lower because they were the plan was to sell them to maturity. So on the balance sheet, they were still reflected at a sensible price. They're not at the liquidation price. If they were forced to liquidate, they would be forced to show a loss, and they wouldn't get the full value that they would likely get if these assets were held to maturity. The reason they were lower is because they held these longer duration bonds. When interest rates go up, the value of the bonds goes down. That's essentially my understanding of it.
That's my understanding as well, is that the a significant number of their assets were it kind of, I guess, can you pull that up again? Can we show that again?
Yeah, happy to. Whoops.
Okay. So as you see, the of their 212 billion assets, it looks like only 74 billion is net loans. And I'm pretty sure that's the category that we had talked about, like the auto loans and the mortgages. So of actually lending out to others, most of their assets were in those long-term, higher interest rate bonds, like including treasuries. But as we talked about, like when we kind of narrow in that spectrum, the longer term, while the risk of default is really, really low, those long term are more subject to interest rate changes. So as interest rates have increased dramatically over the last year, long-term bond prices have come down dramatically. Now, if you hold on to that bond to maturity, you'll get your par value at the end. But it's almost like a chicken and the egg in terms of reasoning. Like there's these, like you can identify the first VC to pull money out, but it was because the interest rates went up, long-term bond values went down. It means asset values have kind of gone down. So now liabilities are greater than assets. And it would have been fine if they all left their money there, because those are lower risk securities if you hold them to maturity. But because they pulled money out, they had to sell some of those long-term bonds at lower than par value and kind of accelerate. Okay, now they have actually do have less assets on their book, and so now other people see that coming out. They want to take that out before that's kind of the start of that bank run. And so kind of like if no one had pulled money out, they probably, not to say probably, they might have been okay. Might have. But it's the combination of they didn't use as much of the regular lending, those net loans. They did more of the higher interest rate long-term securities, because again, they're trying to make their margin. They're lending out money through customer deposits. So they have CDs and savings accounts, and they want to earn a higher interest rate than they're paying. So they have to take on some risk somewhere. And they kind of didn't do the work or the effort, the due diligence to try and increase their net loan portfolio, which is something they kind of have a little more control of. They just went out to the market using treasuries, but longer term. So they were really hit by this combination of the large customer deposits are greater than FDIC insurance. Like you said, the 95+%, which makes them slightly more subject to a bank run, whereas most other large stable banks have large retail customer deposits under that 250. So it's kind of more customer service because there's a lot more customers, but those are not the type of people who need to pull money out for a bank run. So you have more of your clients and more of your dollars in that situation where if there's a bank run, they need to get their money out. You're not lending out via mortgages and auto loans. You're lending out to, like I said, the net loans includes venture debt. So they're lending out to those tech startups that have done poorly over the last year. And they are hurt by interest rates rising over the last year. So it's kind of this combination of those three factors that leads me to believe this is kind of contained. If there's another regional bank with a similar risk profile where they are again high number of high percentage of deposits over FDIC insurance, and not a great lending portfolio, then and a lot of kind of long-term treasuries as on their asset side, like that same risk profile could come out to play, and we could see it again. But if you have your money in Wells Fargo, Bank of America, Chase, you're probably fine. Like they're not subject to any of these same things.
I guess I'll add in a few things. Maybe there's a canary or two here. So
Okay.
Here's the stock price of Silicon Valley Bank Financial Group. And you can see, from 2019, things are kind of chumming along. The business is going smoothly. It's growing. It's increasing deposits. A lot of nice things are going on. And then you can see this acceleration from 2020 to 2022. And I think a large part of that is we saw technology and spending for high-tech companies go up pretty high, pretty quickly over that period as interest rates fell to rock bottom lows during, like the middle of the pandemic, when all of that money started floating around. As we had mentioned at the beginning of this conversation, interest rates fell to zero, and then reserve requirements went even lower to nothing. And basically, it opened the floodgates for tons and tons of borrowing, which did really well for this bank because a lot of people were opening accounts and putting their deposits, and things were quite nice and spiffy. However, interest rates started to rise, over last year. And I think that's what's kind of showing up here in the equity price, which kind of peaked in the end of 2021 and started going down at the beginning of 2022. That's when we really saw that inflationary pressure start to creep up, and we saw the fact that interest rates were being ratcheted up by the Fed. So those long-term rates were being bumped up pretty considerably, from next to nothing to, what was it, like 75 bips every, couple months by the Fed?
Fed funds 7.
So I think it was over 4% over the course of 2022.
Yeah, Wall Street Journal Prime is over 7. Sorry.
Yeah. So I think that the short-term Fed rate ended up being like a 4% jump over the year, from basically 0 to like 4+%.
Yeah.
And this bank, for example,
went from 3 something to 7. Yeah.
Right. Yeah. So this bank, who had a lot of those bonds that they had to buy because they had to put all that deposit money to work in 2021, but they couldn't get any high rates, right? They just had to reach for as much yield as they could get, meaning they had to go longer and longer on the duration of bonds, to the point where they were probably buying like 10, 20-year bonds with less than 1% yield. Yeah. And then you had an astronomical rise in rates last year, so those bonds got creamed. And at that point, some people started pulling out money, and more people started pulling out money. Deposits slowed down, and so on. So you had this kind of vicious cycle and a quick crash down. And basically, over that last week or two, the stock price went from $300 at the beginning of February to like $200 to $100, and then 0. Right.
Yeah. And if you compare that to other bigger banks, as they've been writing mortgages and auto loans over the last year, as interest rates have gone up, all their new debt that they're issuing is at those higher interest rates. They have built in that capacity to make more money as interest rates have gone up, to be able to cover that. Because again, all they're looking for is that spread. And so the reason a new mortgage will be somewhere in the 5 to 7% range is because that's what the bank needs in the current interest rate environment to support all the other things we talked about.
Yeah. Yeah, and depositors are also kind of demanding a higher rate
Yeah.
on their
Yep.
deposits. And how are you going to give somebody a higher rate when all of your assets are stuck in long-term maturity bonds with low rates?
Yep.
You're kind of upside down at this point. People are going to just say, "All right, you messed up. I'm going to take my money out and move it to whatever max my interest says it has a higher side." So you can get into troubles here that clearly Silicon Valley Bank did. Some people call it a perfect storm. I don't know. It seems like
It's
a storm.
yeah, yeah. It was like combination of like COVID led to low interest rates and the reserve requirement going to zero. They were already being more aggressive with their like long-term treasuries instead of following the same path as most other banks of increasing mortgage lending and auto loans. It's like it's not. I guess it's not a perfect storm. It's the like realistic risks that they were taking on came back to bite them. They went after the high deposit businesses and not those smaller retail bank. Like they can look and see, oh, 95+% of our deposits are greater than FDIC insurance. What risk does that mean to us? But like instead of trying to make it easier for retail customers and open up checking accounts, they kept taking on more and more venture capital money and like those other small business high dollar amounts. And like it's not to say that they definitely would have predicted this was going to happen, but there were enough risks that they were taking on that they only needed like these three things to go wrong against them, and they got bit by it.
Yeah, I mean, it's hard to say that interest rates are at zero and they're going to stay at zero, right? It's hard to say. Say a lot of things, but there's even more behind the scenes. This was from The Guardian, but basically a few things. Silicon Valley Bank, before it grew to its size, was a $50 billion bank. And there was regulations in place to have stricter lending policies and banking policies for banks that were 50 billion and above. But they specifically lobbied to raise that to 250 billion, meaning to remove the checks and balances for banks between 50 billion and 250 billion. And that legislation passed. So part of the reason that they weren't following these stricter rules is because they didn't have to, because of legislation that they advocated for. In addition to that, I'm just going to highlight this. I'll include the article. But reportedly, they didn't even have a chief risk officer leading up to the collapse. So
there's not even looking at the risks that they're taking on.
Pretty much head in the sand. I remember, when I was closer to the banking industry, a part of the things that we were looking out for are this notion of losses and expected losses, right? And losses given defaults and all of these things that are important to track. These were part of the Basel II Accords, which was an international consortium of banking regulations that has been trying to be adopted by U.S. banks. When this was 10 years ago, I don't know if they've even come to the point where they're fully adopted. But the goal of these regulations was to provide more structure around what to do under stressful situations, meaning specifically stress test what happens when interest rates rise, stress test what happens when depositors leave, and all of that, and prove to us that you're actually doing these types of things. Frankly, I don't know where the legislation is now at this point or what happened internally, but it seems like there was a lax environment around these types of concerns.
Yeah, I agree with that. And it's like, I wonder if reserve requirements were at 10%, would they have been affected? Like if you change just like one of those things, which like were normal things, if it wasn't so heavy in the tech sector, because like when you showed that chart of Silicon Valley Bank, like that looks the same as like the NASDAQ or any tech ETF, like that increase in like that same exact shape over the same time frame.
I'll put some context. So let me add Microsoft in there. All right, let's see.
So I think I just pulled up NASDAQ.
Okay, I probably should have done that, but
It's okay.
Anyway, here's Microsoft. Yeah, kind of, right?
Oh, can you add a NASDAQ to that easily, or is that?
Yeah, I can, sure.
Because it's an index, I don't know how easy that is.
Yeah, it's there. I got it.
Okay.
Let me take away Microsoft. Let's.
Okay. Well, that's NASDAQ's going to be more diversified, but same times, kind of same shape, just less amplitude.
Yeah. And of course, the downside.
Yeah.
A couple of lessons, maybe, for the individual when it comes to the markets, this is a key lesson in diversification, right?
Yeah.
If you're tied to one of these companies and you have a large compensation tied to this company, we've talked about this before in other situations, right? Microsoft, should you keep all of your stock in Microsoft or should you diversify out? The notion there is every company has the potential to completely go to zero, but the chances of a broad market index going to zero are far less.
Yeah. That's the conversation I have with clients who have large company stock positions. Like, what does your life look like if this goes down 90+%?
Right.
What does your life look like if this goes up 3x? And is that upside worth the risk that you're taking on? For some, like, as long as I max out my 401k for the next 20 years, I'll be fine. For others, it's, oh wow, I don't need that much extra money for that much risk, and okay, let's diversify.
Yeah, so it's that whole notion of concentration risk, right? And concentration risk is exacerbated when it's your employer, meaning your employment and your paycheck counts as part of that concentration, in my mind. That's a big part of your future net worth, which should be taken into consideration.
Okay, so I don't have any clients who had money at Silicon Valley Bank, at least not that they've told me. So I do think, so I was going to say, like, most likely this is contained, but it's entirely possible if there's another bank with a similar profile. I don't do research onto bank reserve requirements for each bank in the country, so I don't know that for sure, but it's entirely possible that there's another bank or two or three or four that have a similar profile and that they could also be at risk. But if you use one of the huge national banks, you're going to be fine.
Yeah, I'd say, especially if you're under that 250K limit. If you're not, there's plenty of time to rejigger things so that's not a concern. So you should have probably done that yesterday, not April 18th when this comes out.
That's a good point. We're really good at this, like not even ex post. We're like middle of the fact, but you don't learn it till later. Related. We recorded a March Madness podcast last year, and didn't get it released until after March Madness. But people are gonna listen to this on April 18th after March Madness. I realize it doesn't matter anyway.
Okay. Well, it's out there now, so
yes.
If you're
okay.
listening,
We'll try to broadcast it via other means. This is not good marketing for the thing that's too late. Okay, sorry, I had that thought. Like, we recorded March Madness. March Madness is coming up, but for people actually listening to this in April, it's too late. Again. Right. So, well, it's a good chat, good conversation. Lot more about FDIC insurance, and I've never heard anyone else pronounce it SIPC. Everyone I know has said SIPC.
I know. I've heard both. I think maybe because in like a recent news interview, I heard it as SIPCA, so I'm like, all right, I'll go with it for now.
Okay. No one says FDIC. It's always
it's harder to do that without a vowel.
It's FDIC and SIPC.
Yeah. Right.
Okay. Well, good chat today.
Yep. Good stuff, Aaron. So thanks everybody for listening. I hope you enjoyed watching or hearing the conversation. And if you are enjoying these episodes, if you're on YouTube, do subscribe. That helps. Also, the likes apparently help a lot as well. So we appreciate that. And, thanks. Take care.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.